It is already here, not coming, not looming, not on the horizon, already here, right now. While you watch this video, the next financial crisis is unfolding in real time. Banks are failing, debt is exploding, markets are fracturing, and 99% of people have no idea because the collapse is happening in slow motion, invisible, until it is not. March 2023, Silicon Valley Bank collapses in 48 hours. The second largest bank failure in American history. Then First Republic, then Signature. 3 major banks gone in 3 months. And the mainstream media told you it was contained. They lied, because the same forces that killed those banks are still active, still spreading, still destroying balance sheets across the entire financial system. And when the contagion reaches critical mass, it will not be 3 banks. It will be 30, then 300. Then the system itself. Here is what they are not telling you. US banks are sitting on $620 billion in unrealized losses. $620 billion. That is money already lost, but not yet recognized. Hidden in balance sheets, buried in footnotes, waiting for the right trigger to detonate, and that trigger is interest rates. The Federal Reserve raised rates faster than any time in 40 years. From near zero to over 5% in 18 months. Every bank that bought bonds at low rates is now sitting on assets worth 30 to 40%. Less than what they paid. They are insolvent. They just have not admitted it yet. The crisis has already started. The question is not if it will get worse. The question is whether you will be ready when it does. Before we show you exactly how this crisis unfolds and what you need to do to survive it, hit that subscribe button and join the Wealth Forum. We break down the financial earthquakes before they destroy your wealth and show you how to build during the collapse. Turn on notifications. What comes next could save everything you have worked for. Now let's talk about how we got here and why this crisis is different from anything you have seen before. Let's go back to 2008, the last major financial crisis, the one everyone remembers. Banks collapsed because they made bad loans. Mortgages to people who could not afford them. Those loans were packaged into securities, rated AAA, sold globally, and when homeowners defaulted, the entire system froze. Lehman Brothers failed. AIG nearly collapsed. The global financial system came within hours of total shutdown, and it took trillions in bailouts to prevent catastrophe. Here is what people forget. The 2008 crisis was caused by bad loans. This crisis is caused by good loans. Loans that are being paid back. Bonds issued by the US government. The safest asset on earth. Except they are not safe anymore. Because when interest rates rise, bond prices fall, and banks own trillions of dollars in bonds bought when rates were near zero. Those bonds are now worth far less, and banks are trapped. Think of it like this. You buy a house for $400,000 with a 30-year mortgage at 3% interest. That was a great deal in 2020. But now mortgages are 7%. So your house is worth less, not because it is a bad house, but because nobody wants to pay full price for a 3% mortgage when they can get a new house with better terms. The same logic applies to bonds. Banks bought bonds at 1%. Now new bonds pay 5%. So old bonds are worth 30 to 40% less. The banks did nothing wrong. They followed the rules. And they are still insolvent. Here is the terrifying part. In 2008, the Federal Reserve lowered interest rates to save the banks, cut them from 5% to near zero, flooded the system with cheap money, bailed out the failures. But this time, the Fed cannot lower rates because inflation is still at 4%. If they lower rates now, inflation explodes again, prices skyrocket, the dollar collapses, so the Fed is trapped. Keep rates high and banks fail. Lower rates and inflation destroys the currency. There is no good option, only bad and worse, and it gets even more dangerous. Since 2020, the US government has added $10 trillion in debt. $10 trillion in 4 years. The national debt is now $34 trillion and climbing. Every dollar of that debt has to be financed with treasury bonds. And those bonds are being sold at 5% interest rates. That means the interest payments alone on the national debt will soon exceed $1.5 trillion per year. $1.5 trillion just to service the debt, not to fund roads, not to pay for defense, just interest. This is not sustainable. It is a debt spiral. More debt requires more borrowing. More borrowing increases interest payments. Higher interest payments require even more borrowing. And the cycle accelerates until something breaks. That break point is the crisis, and we are closer to it than most people realize. Now let us talk about the mechanics. How does a financial crisis actually unfold? What are the stages? And what triggers the collapse from slow motion to free fall? Stage 1 is the hidden damage. Right now, banks are sitting on $620 billion in unrealized losses. That number is public. It is in the Federal Reserve's own reports. But unrealized losses do not hurt you until you have to realize them. As long as banks hold those bonds to maturity, they can pretend the losses do not exist. They mark them as held to maturity on the balance sheet, and regulators allow it. But there is a catch. If depositors start withdrawing money, banks have to sell those bonds to raise cash. And the moment they sell, the losses become real. The bank takes a massive hit, and if the hit is big enough, the bank fails. Stage 2 is the confidence crack. This is what killed Silicon Valley Bank. SVB had billions in bonds bought at low rates. When the Fed raised rates, those bonds lost value, but SVB was fine, as long as depositors left their money in the bank. Then one day, a few big depositors got nervous. They started withdrawing. Word spread, more depositors withdrew. SVB had to sell bonds at a loss to meet withdrawals. The losses wiped out capital, and within 48 hours the bank collapsed. Not because of fraud, not because of bad loans, because of a bank run triggered by interest rate risk. Stage 3 is the contagion. When SVB failed, people looked around. Which other banks have the same problem? First Republic had it. Signature had it. Regional banks across America had it. And depositors started moving money, not to mattresses, to bigger banks. JP Morgan, Bank of America, Wells Fargo. The big systemically important banks that are too big to fail. This created a two-tier banking system. Big banks getting bigger, small banks losing deposits, and the stress concentrated in the regional banking sector. Stage 4 is the credit crunch. When banks are under stress, they stop lending. Why? Because lending requires capital. And if your capital is being eroded by bond losses and deposit outflows, you cannot lend. So credit tightens. Small businesses cannot get loans. Mortgages become harder to obtain. Corporate borrowing slows, and the economy starts to freeze. Not because demand disappeared, but because the financial plumbing stopped working. Stage 5 is the real economy impact. When credit disappears, businesses fail. They cannot refinance debt. They cannot fund operations. They lay off workers. Unemployment rises. Consumer spending falls, and the economy tips into recession. This is the moment when the financial crisis becomes visible to everyone. Stock markets crash. Unemployment jumps. GDP contracts. And suddenly the crisis everyone said was contained is now a catastrophe. But here is the key. The catastrophe does not start in stage 5. It starts in stage 1, with hidden losses, and by the time you reach stage 5, it is too late to protect yourself. The damage is done. Your savings are trapped in a failing bank. Your investments are down 40%. Your job is at risk, and the government is scrambling to respond with policies that may or may not work. This is why understanding the mechanics matters, because right now, we are in stage 3. Contagion. Regional banks are losing deposits. Credit is tightening, and the economy is slowing. We have not hit stage 4 yet, but we are close, and once stage 4 begins, stage 5 follows fast. Now let us talk about the crisis, the turning point. The moment when slow motion becomes freefall, and what that looks like when it happens. Here is the moment everything breaks. It starts with one of 3 triggers: a major bank failure, a sovereign debt crisis, or a stock market crash. Any one of these can light the fuse. Let us go through each. Trigger 1 is a major bank failure, not a regional bank like SVB. A systemically important institution. Think JP Morgan, Bank of America, Deutsche Bank. These are banks with trillions in assets. Thousands of corporate clients, millions of depositors. If one of these fails, the contagion is instant and global. Counterparties freeze, markets seize, liquidity vanishes, and central banks have to intervene immediately, or the system collapses within days. Here is why this is possible. Deutsche Bank has 1.5 trillion in assets, but only 60 billion in equity. That is a 25-to-1 leverage ratio. A 4% loss on assets wipes out all equity. And Deutsche Bank has significant exposure to European sovereign debt, commercial real estate, and derivatives. If any one of those sectors cracks, Deutsche Bank is at risk. And if Deutsche Bank fails, it takes the European banking system with it. And Europe takes the world. Trigger 2 is a sovereign debt crisis. This is when a major government cannot pay its debts. Not a small country like Greece, a big one like Italy or Japan, or even the United States. Right now, the US is paying $1.5 trillion per year in interest on $34 trillion in debt. If interest rates stay at 5%, That number goes to $2 trillion, then $2.5 trillion. At some point, the interest payments become larger than tax revenue, and the government has two choices: default or print money. Default destroys the bond market. Printing money destroys the currency. Either way, the financial system breaks. Japan is even closer to this edge. Japan has a debt-to-GDP ratio of 260%, the highest in the developed world, and Japan has kept interest rates near zero for 30 years to avoid a debt spiral. But inflation is forcing the Bank of Japan to raise rates, even slightly, and when they do, the cost of servicing Japan's debt will explode. If Japan's bond market breaks, it will trigger a global flight to safety. Investors will dump everything risky and rush to US Treasuries. Except US Treasuries are part of the problem. So where does the money go? Gold, Bitcoin, real assets, and everything else collapses. Trigger 3 is a stock market crash. The S&P 500 is currently trading at a price-to-earnings ratio of 25. Historically, the average is 16. That means stocks are 56% overvalued relative to historical norms. Why? Because cheap money from the Federal Reserve inflated asset prices for over a decade. But now rates are high, earnings are under pressure, and valuations are unsustainable. If the market corrects to historical norms, the S&P 500 would drop from 5,000 to 3,200. That is a 36% decline, a crash. And here is the feedback loop. If stocks crash, consumer confidence collapses, wealth effect disappears, spending falls, corporate profits drop, and the economy tips into recession. Recession increases unemployment. Unemployment reduces tax revenue. Lower tax revenue increases deficits. Higher deficits require more borrowing. More borrowing pushes interest rates higher. Higher rates make the debt unsustainable. And we are back to trigger 2, sovereign debt crisis. This is why the system is so fragile. Everything is connected. A bank failure triggers a stock crash. A stock crash triggers a recession. A recession triggers a sovereign debt crisis. And a sovereign debt crisis triggers more bank failures. It is a doom loop, and once it starts, it is almost impossible to stop without massive intervention. And here is the terrifying reality. The intervention tools are already exhausted. Interest rates are at 5%. The Fed has limited room to cut. The national debt is $34 trillion. The government has limited room to borrow. Bank bailouts in 2023 already cost hundreds of billions. There is limited political will for more. The central banks and governments that saved the world in 2008 are out of ammunition, and when the next crisis hits, they may not be able to stop it. The turning point is not a single moment. It is a cascade. One failure triggers the next, and the next, until the entire system is in freefall, and the cascade has already begun. Now let us talk about the consequences. What happens when the crisis goes from slow motion to full collapse? And more importantly, what do you do to survive and even thrive during the chaos? Here is what happens when the crisis fully unfolds. And here is exactly what you need to do right now to protect yourself and build wealth during the collapse. Consequence 1 is bank failures. More banks will fail, not just regional banks, big ones. Your deposits might be insured by the FDIC up to $250, you know. But if multiple, large banks fail simultaneously, the FDIC does not have enough money. The FDIC insurance fund is only $128 billion. If JP Morgan fails, that is $3 trillion in deposits. The math does not work. So here is what you do. Diversify your deposits across multiple banks. Keep no more than $200,000 in any single institution. And consider moving a portion to credit unions or offshore accounts. Do not keep all your eggs in one basket. Consequence 2 is currency devaluation. To prevent total collapse, central banks will print money. Trillions of it. They did it in 2008. They did it in 2020. They will do it again. And when they do, your cash loses value. Inflation spikes. Purchasing power collapses. So here is what you do. Get out of cash. Buy hard assets gold and silver have. Preserved wealth through every financial crisis in history. They cannot be printed. They cannot be devalued by central banks. Buy physical gold, not ETFs. Not paper gold. Physical metal you can hold. And store it securely. This is your insurance policy. Consequence 3 is stock market volatility. Stocks will crash, then rally, then crash again. This is not the time to panic sell. But it is also not the time to stay fully invested in overvalued markets. Here is what you do. Reduce exposure to high valuation stocks. Tech stocks trading at 50 times earnings. Meme stocks with no profits. Speculative plays. Move into defensive sectors. Utilities, healthcare, consumer staples. Companies that provide essential goods and services people need, regardless of economic conditions, and keep 20 to 30% in cash or cash equivalents to buy the dip when panic selling creates opportunities. Consequence 4 is real estate correction. Housing prices will fall. Not everywhere, but in overheated markets where prices disconnected from fundamentals. Here is what you do. If you own a home with a fixed-rate mortgage at 3%, do not sell. That mortgage is an asset in a high-rate environment, but do not buy real estate at current prices expecting appreciation. Wait for the correction. When distressed sellers emerge and prices drop 20 to 30%, that is when you buy. Residential rental properties in stable markets. Commercial real estate at deep discounts. Real assets bought at crisis prices generate wealth for decades. Consequence 5 is opportunity. This is the part most people miss. Every financial crisis destroys wealth, but it also transfers wealth. From the unprepared to the prepared. In 2008, investors who bought stocks at the bottom made fortunes. In 2020, those who bought real estate during the pandemic panic are now sitting on massive gains. The next crisis will be the same. Panic sellers will dump assets at fire sale prices, and disciplined buyers will acquire generational wealth. Here is your action plan. First, secure your foundation. Eliminate high-interest debt. Build an emergency fund covering 6 months of expenses. Diversify bank deposits. Second, protect your wealth. Move 10 to 20% of your portfolio into gold and silver. Reduce exposure to overvalued stocks. Hold cash for opportunities. Third, prepare to deploy. When the crisis hits and assets are on sale, you need to be ready to buy. Not emotionally, strategically. Make a list right now of assets you want to own. Real estate markets, dividend-paying stocks, commodities. When prices crash, execute the plan. Fourth, increase income streams. A financial crisis destroys jobs. If your only income is a paycheck, you are vulnerable. Build side income, freelance skills, rental income, online businesses. Multiple income streams provide resilience when one fails. And fifth, educate yourself. The people who survive and thrive in crises are those who understand what is happening and why. Read, study, learn how the financial system works. Because knowledge is the ultimate asset, and it cannot be taxed, inflated, or confiscated. The crisis is not coming, it is here. But crises create millionaires. And the difference between those who lose everything and those who build generational wealth is preparation. You now have the knowledge. The question is whether you have the discipline to act on it. So here is the lesson. The next financial crisis is not a future threat. It is a present reality. The damage is already done. The losses are already locked in. The contagion is already spreading. The only question is when the slow-motion collapse becomes an avalanche, and whether you will be ready when it does. History teaches us that financial crises are inevitable. They happen every 10 to 15 years. 1987, 2000, 2008, 2020, and now. The system is designed to create bubbles. And bubbles always pop. But history also teaches us that those who understand the cycle and prepare accordingly do not just survive. They thrive. They buy when others panic. They hold when others sell. And they build wealth while the masses lose everything. The unsettling truth is this. Most people will ignore this warning. They will assume it will not happen to them. That the government will fix it. That their bank is safe. That their portfolio will recover. And they will be blindsided when the crisis accelerates. Do not be most people. So here is what you do. If this video made you realize the crisis is already here and you need to act now, smash that like button. Subscribe to the Wealth Forum. Turn on notifications. Share this with anyone who still thinks their wealth is safe in this system. Because the next video breaks down the exact assets to buy during the collapse and how to time your entry for maximum gains. You do not want to miss it. But before you go, leave a comment. Tell me this. Are you ready for the next financial crisis? Or are you still hoping it will not happen? Because your answer determines everything. And I want to know if you are prepared or in denial. The crisis has already started. The only question is what you do next.